You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
And hello, everybody, and welcome to the Option Block, the show that brings you the new, the cool, the what's happening with the options world. This week, March 9th, 2015, it is Andrew Giovinazzi filling in for the inestimable, I'm trying to think of the right word, Alex, inestimable Mark Longo from the Options Insider Radio Network. We're having, an interesting day in the market today, recovering a little bit from the FOMC, the non-farm payroll report on Friday. We're getting a little bit of pop in the market. But first, before we get to that, we have to introduce the cast of characters for today's show. And besides myself, we have the man with more hats than anybody in options radio, Mr. Mr. Alex Jacobson. Welcome back to the show, Alex.
Andrew, it's good to be here today. And today was kind of a funny day because even though the market was up, it didn't feel like an up day. But a lot of interesting cross currents in the market today. The European Central Bank began its version of quantitative easing today, and huge moves in some of the interest rate products. But it didn't feel like the market was up. Most of the day it was up about 10 on the S&P. Today just seemed quieter, but we'll talk about that as the show progresses.
Okay, we can hit that. We are going to have a late arrival from Mr. Tusaw. I have a feeling with the arrival or possible arrival of the iWatch, he was quite busy today, running up and down from his desk over there at RCM Wealth Advisors. But for right now, we're going to move right into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
Hello, everybody, and welcome to the Trading Block. This is a portion of the show where we break it all down, the interesting, newsworthy, and, well, of course, the trade that happened today. Alex was just talking about lots of movement in interest rate products. The ECB is, I guess, doing their thing. Alex, where are they going to drive rates to? Aren't they already at zero?
Well, the German rate, based on the rate, the German did about a 400 vol today. Their 10-year is now trading about a quarter. So, yes, it looks like they're driving it to zero, but a phenomenal move. I mean, a 23% move in a day based on the rates. So it always surprises me because this was well announced. It was transparent. They pretty much told everyone what they were going to do and when their start date was. And today the market reacted. So, yeah, to your point, zero or less. I think a lot of the stuff their bank was buying today. If they were buying shorter paper, they were buying negative yield paper. And I got to go pull out a college textbook to remember what that means. But huge reaction there today. Oil was up a little bit today, but pretty much unchanged. And, as we said, our market was up, but it just seemed quiet today.
It had the feeling of nobody really wants to do anything today. We had oil up, but then we had a lot of the oil drillers, producers kind of down on the day. We had Apple. I guess of course we want to wait for Tucson, but they debuted their Apple Watch, and predictably Apple had a 2-point range today, but ends up finishing the day only up 48 cents. So of course the volatility came crashing in here at the end of the day in Apple. So the watch was, at least from a stock mover point of view, like, okay, we launched it, now we have to sell it. So I don't know, did you have any action really in Apple today on the desk, or did the Options Express clientele just sort of watch that one and walk on by?
No, there was action today. There was action last week as well, people positioning for it. And obviously there were people who thought, this was going to be a $10 up week in Apple, that the watch would be a surprise. Obviously other people thought this was going to be a $10 down week in Apple. The watch was going to be a non-event. The watch had been well telegraphed. I think, all the pictures today of the watch itself are not vastly different from the stuff that had been telegraphed. So today's news in Apple, as you pointed out, Andrew, is pretty much a non-event. The only other big standout on our desk today continues to be lumber liquidators, which lost, I think, another 5 points today. So this is one of those where you've had plenty of time to buy the puts, and we saw activity today in both the March and May, ironically, not so much the April, but across strikes. And in May, they were buying the 25, so they think it's going to continue to get worse with LL.
Yeah, it's not a very pleasant looking stuff. Apparently, I guess their flooring is used quite a bit. I mean, some actually just, I talked to some contractors, some like it and some don't. I for whatever reason, they've never really recovered from that 60 Minutes article on them. So I think the stock's kind of in no man's land right now. It's basically a lot of things could happen, but nothing has really happened, apparently. That's sort of how it looks like it reads to me.
Yeah, it's half of what it was. I know 60 Minutes went back and revisited it this weekend. I kind of caught the tail end of the show, but 60 Minutes did a small piece this weekend, and they kind of revisited it and reinforced what they had said. And that company's lost half its market value in about a week. So it's not been an interesting week. If you're a stockholder, it's been a real interesting week. If you're a stockholder, it's been a real painful week.
Yeah, you've lost a serious amount of money in there. I think one other thing, we are waiting. I think we're going to have kind of a slow week from a vol point of view. Overall, VIX fractionally down today. Volatility futures down. Volatility kind of across the board, a little lower. It looks like it started to catch a slight bit at the end of the day, but still finished the day a little lower. And an interesting, Sebastian was at the SIBO Risk Management Conference, and they talked about cross asset volatility, and they talked about kind of the VIX not being able to get to some of the lows that it used to be because option buyers are blowing the skew out. So I guess the lesson from 2013 and 2014 and even 2012 is, I think fund managers now are starting to buy more index puts for protection, and it's keeping index put skew very high. And at the same time, a lot of customers and funds are selling name volatility puts against, and it's kind of causing a bit of a not a skew, but a dispersion of volatility, where index puts cost a lot and name puts don't cost very much. And discussing there could be a trade there at some point, but there's everything in finance is trends. I know you've seen a lot of trends, Alex, going forward, but I found it interesting that index skew was expensive enough for some panels to mention it at the SIBO Risk Management Conference. Did you did you read any of the info coming out of there?
I did. In fact, I read the white paper on the cross asset skew that they released today. The interesting thing about that is, to your point, I mean, there used to be lots of dispersion books that would try to bang that relationship back in, and I just don't think there's that much capital chasing dispersion anymore. The vol desks have very much embraced the VIX and the S&P products, but the single stock vol and the desks trading it, every delta neutral trade that used to go up, quote unquote, used to be a vol trade. I just don't know that there's that much money doing it anymore. And of course, what that means? It means it'll get out of line, and then people will decide to come back into it. But I think that's been a difficult business for a number of years, and a number of folks just, closed up shop and got away from it.
I know a couple of people on different desks where they, and a couple of large firms just shut all that down. It's like, but then the market becomes interesting again for, people that like to trade volatility, because there's nobody there to bang it into line. Also, that means you have to wait a little longer for things to get out of whack because there's nobody there to correct it. And we know that those vol markets can stretch quite a ways before they snap back the other way. So, I think there was some interesting things coming out. I think a bit of a story is oil, as the latest bugaboo now is, OPEC basically saying, we kept the supply going, and I don't know if they say they try to damage the shale frackers in the U.S., but certainly sounds like maybe they were thinking about it. And then you've got that on top of the bugaboo of we're running out of storage at Cushing. That was another headline that kind of went across the tape. So, I mean, even with that news, we have oil up, or just, fractionally today, a couple of cents, not that big of a deal. But with that kind of news out, that was sort of, let's just call it, certainly not bullish. And then there was more reports of Goldman saying $40 oil. Kind of reminds me when Goldman said that the SPX was going to 1,200, right? Through when Greece first voted on, well, I guess it was basically that referendum staying to euro in around June 2012. It seems like shades of that kind of, where you kind of have all the bad news or a bunch of news that comes out, seems to paint the tape a little bit, but you don't really have much of a reaction from the commodity itself. It's more of a, it's almost like folks are waiting for that news to come out.
Yeah, and the CME last week or the week before started trading of a new contract, and it's storage at one of the ports. It's I forget which one it's at, but they're actually trading a future now on storage costs. So clearly that's, as you point out, becoming a major issue.
I guess that will be the latest squeeze indicator. Because can you imagine how tight that contract is going to become. I don't know if I want to make a market in that future. That could get just darn right ugly.
Yeah, absolutely. And I certainly don't want to be short that contract when they run out of storage. I forget which facility it was, but it's specific to a specific large oil facility. So it's clear that the issue of storage is, kind of front of mind if CME actually has a contract running on it.
Right. It sounds like kind of a mess. It sounds like a mess waiting to happen. Because, of course, the financial crisis, everybody blames the Wall Street banks and all that for securitizing all these, for securitizing basically risk on mortgage-backed securities and things like that. And now they're going to securitize storage, and we're going to run out of that. But, of course, it's the easiest way to have a price signal when you actually trade something on it. So. All right, not a bad kind of rundown of the day, I think. I guess probably with that we should cut out of the trading block and move into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
Okay, everybody, welcome to the Odd Block. This is the part of the show that we have. Well, it has the best music, of course. Not a bad editor either, as we look at sort of the large, sometimes head-scratching, every once in a while, the $2 biotech type name. As the paper goes flying across the tape, we, the experts at the Option Insider Radio Network, try to pull it out and dissect the paper. And I might have a couple of guests on. Now, I have a couple of guests now for the odd block. There are some interesting trades here. I think that might have some, let's say, call them interest rate ramifications. Today, first off, an IYR, this is the iShares Dow Jones Real Estate ETF. It was trading up around 29 cents today to 76.73. And, it's about the middle of the 52-week range. And today we had paper buying 4,787 of the IYR April 75 puts for $1.35. Now, the ADV on this contract is fairly big. It's not a normal oddball special or an odd special. It's a little over 40,000 contracts. The open interest on these 875 puts are around 700 contracts. So opening paper, taking the offer, and one thing I noticed on the volume is we saw a lot of action sort of into the April and other action closing, let's say, March contracts and closing prior to this March 18th Federal Open Market Committee minutes release. So if you're looking at this type of paper, what would you take from that, Mr. Tusaw? Somebody's buying some puts on the Dow Jones U.S. Real Estate ETF. Do you think that has any interest rate sensitivity?
I don't see how it couldn't. I mean, with interest rates ruling the world like they seem to these days, and with the exception of Apple, it seems like the only thing that we ever talk about on here, or in general, I shouldn't say the only thing, but one of the biggest things that we talk about is what's the Fed going to do? What's the Fed going to do? Are they going to raise rates sooner? Are they going to raise rates later? What if they raise rates too soon? Oh no, I don't see how that couldn't be, quite honestly.
Now, I've got a question because you've been around for a while. I know Alex has been around maybe as long as some of his clocks and watches. However, do you remember early on, did anybody really care if the Fed was really going to raise rates or not? Do you remember the constant every FOM? I didn't even hear of an FOMC meeting until after 2008, to be honest. Is this going to stay with us forever?
I think, when I first remember really hearing about the Fed was right after 9/11 when Greenspan lowered interest rates. And I can see where that would play a role in markets and why that's important. Didn't really hear about it quite as much, but it's like it was like a gradually rolling snowball until, like you said, 2007, 2008, around that time. And then that's the only thing we ever talk about anymore. It seems like, well, is that if we get a good employment report and the market's going to go down, because that's really bad news, because it means the Fed's going to raise rates sooner. And it's just like this, and I reference this on the show all the time. It's a Princess Bride type of market where they're in the battle of wits, and they think, well, that's just what you want me to think, because you would think that would be it. No, that's not what you would think that. And then that's what it feels like whenever we talk about the Fed.
All I can say to that is inconceivable. Inconceivable. So we do, as we get back to the odd block, but I think you're right. This is it's an interest rate play. It's a short-term interest rate play, I think, on if all these are, interest rate sensitive real estate, basically it's just a holding of REITs. If it's going to perform, it's going to fall apart like it did when we had the last Fed shock, a year and a half ago or so. So somebody clearly, somebody is making that bet anyway, that we're going to see the IYR tank at least somewhat after March 18th. Here's one. Maybe this one's just for Alex. It is a CITC, CIT BioPharma Corp. Let's just in case, what does it do? Guess. It is a biopharmaceutical company focused on the acquisition, development, and commercialization of less toxic ways to treat cancer. I almost think you could take that description and toss it on any biotech company there is. And then you have to have names like Pixintrone and all kinds of other, obviously the work they do is, very good, but all these little biotechs, after trading them for 20 years, they all kind of all get jumbled in my head. But this, again, I brought this one up as just a plain interesting trade. So CTIC, the March 2 puts, traded for 4 cents. Now, CTIC is a $2.77 stock. They have earnings. I believe they were today or tomorrow, really close in the cycle here. And somebody was short 10,000 of these puts, and they wanted to buy them back for 4 cents. Now, I applaud buying back short option contracts. And actually, as early as, I want to say mid-February, the stock was trading around like $2.25. So, I think they made good money on these puts. We've had kind of the biotech buyout binge. So I guess I would ask Alex, from your point of view, have you still seen lots of biotechnology action coming across the desk since the last few takeovers have been announced?
Yeah, and they're sparked by the takeovers, and then they get quiet for a couple of days. But the big run-up in some of the names, I mean, Biogen IDEC is kind of always active here. Regeneron tends to get active, and, they're both blockbuster drug companies. But to your point, I roll my eyes every time these low-priced ones get any kind of activity. But biotechs continue to be hot in terms of our customer base.
Yeah, because last time I looked, I think, I don't know if that's I think the iShares, the IBB, is trading real near a one-year high at least. So only a couple of dollars away from that. So I guess biotech is still the king. I wonder where this index was. I wonder if it's up tenfold since the mid-90s. Probably at least since the grand old days of trading biotech. So anyway, it's just a customer here, I think, locking in some profits. And right now, kind of a savvy customer, as CITC probably waits for their first real product to hit the market. So interesting, I thought about the CITC trade or CTIC trade. The customer did not roll to another month. They just closed their short puts and said, thank you very much. So they obviously were not ready to tempt fate twice, selling those out of the money puts. And last here, but not least, is a new name to the odd block, GLPI, Gaming and Leisure Properties. This company actually used to be it's now a holding company for Penn National Gaming that owned casinos in Louisiana, Maryland, and I guess I will just call it kind of second tier type of properties. Maybe the company doesn't see it that way, but it's not a ton of properties that are mainline in Vegas. But be that as it may, I believe they converted to a REIT. They pay a pretty heavy dividend. So what's going on in GLPI? Paper traded 489 of the July 39.6 calls for 60 cents. Now, Gaming and Leisure Properties, we'll just call it, and I almost want to say Gallipoli, GLPI. It's up $3.27 today to $35.64. I do not know what that news was that caused that jump. I don't know if the news from Macau or China has gotten better on gaming properties. But somebody buying, long-term upside calls in a REIT is, I'm just going to say that doesn't happen very often. Maybe there's some potential buyout spec or something like this. But actually, over 1,000 of the July 39.6 calls traded. At the time, of course, why it made my list is that paper actually paid through the posted offer for some of the volume. So you want to buy calls in a REIT that expire in July and you pay through the offer to buy them. Again, just I can only say that is head-scratching paper. The calls are basically right around the same spot as they were earlier today. So, the company got a big lift. It looks like they're also buying April near the money, or actually they were at the money calls. Now they're $2 in the money. I saw some April 34.6 buyers. So it looks like there was some sort of stub or spin out to get the adjusted strikes. But I think here just straight up upside call speculation on what looks like kind of a vanilla REIT, but clearly this type of paper is not vanilla REIT paper. Do you guys follow this Gaming and Leisure Properties at all, or is this just one of the most obscure titles that I've yet to come up with on the odd block?
They actually offered to buy out another gaming property this morning, which is, I think, what generated the pop. They offered to buy out the assets of Pinnacle Real Estate, which is another gaming property, and I think that's where the interest spark came from today.
Mike, you were about to pop in on something? Alex, that sounds entirely right.
Yeah, I can't say this is one that I follow with a fine-tooth comb by any means, but yeah, I think this is about as bullish as you're going to get. Just buying lots of calls. Unless for some odd reason he's hedging his short position, which I don't think he is. This to me looks like someone who is just very bullish.
So it's also like the strange trend lately of the acquiring company stock goes up 10% on the. I guess the market must think they are buying the cheapest gaming company real estate portfolio in the world, because I don't see how it could be that accretive right away. But hey, apparently somebody thinks so, or if there were players that had a short position, they look like they could be covering today, because this is a day that they probably got run over. So anyway, an interesting batch of mostly odd paper on kind of a sideways day, I would say, at least sideways feeling. Even Alex, I think he expressed it well, as we were up on the day, but it felt down. And with that, I guess we can roll out of the odd block and roll right into Alex's favorite portion of the show, the Express Block.
The Express Block. Brought to you by Options Express by Charles Schwab. Options Express by Charles Schwab lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources. Options Express by Charles Schwab is the online broker for all traders. Best of all, Options Express by Charles Schwab lets you trade stocks, options, and futures all in a single account on powerful yet easy-use trading platforms, including mobile devices. Visit optionsexpress.com for your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome to the Express Block. This is the part of the show where the man with the most hats, watches, and maybe cars opines on all things Options Express. And all the new goodies coming out from Options Express by Charles Schwab. All the new goodies coming out of said company. So, Alex, with that, I guess I'll just leave it to you to express on the block.
Thanks, Andrew. This weekend, the Weekend Barron's magazine did its annual ratings of the brokerage community, and this always makes it fun in the space here because we kind of get to look at our own report card and what they showcased and what they liked. So one of the things that was mentioned in the Barron's article, they liked a number of things both at Options Express and Schwab, but one of the products that they showcased is the walk limit product, and I'm just going to spend a minute and focus on walk limit. I know I've talked about it repeatedly on the show in the past, but you're a savvy trader and you're trading an individual option or you're trading a spread, and there's a generous bid-offer spread. Now, generous is a polite term for saying the markets are wider than anyone would like. And maybe if it's a single option, it's trading something like 30 cents, 60 cents. And any savvy trader would look at that and say, there's no way I'm going to sell it for 30 or buy it for 60. I'd like to trade maybe in the 40 to 50 cent area. Well, walk limit does exactly what a savvy trader would do. It allows you to enter a limit, and if it's a debit, it allows you to specify how you like to walk the limit up. So for example, if I were going to buy that 30-60 spread, you say, look, realistically, I'd like to buy it at 40, but I suspect I'm going to pay closer to 45 or 50. What the walk limit product allows you to do is to do exactly that. It allows you to start the auction at 40 cents, send the order via the Options Express routing system, the Options Express smart router, to the marketplace where that spread or that single leg trades, or number of marketplaces it might trade. It's only going to send it to one, and then it's going to work the order. So let's say I'd like to buy the spread at 40, but realistically I think it's going to cost me more in the 46 or 47 or 48 area. But you know what? Let me see if I can get it done at 40. What most traders would do on most platforms is they'd enter a limit order to buy at 40, and they'd let it sit out there for some period of time, and then they do a cancel and replace, and they'd re-enter it at, pick a number, 42, 43. Spreads trade in pennies, so you can enter the spread in pennies. So what walk limit would allow you to do is say, look, Options Express smart routing computer, I want you to do this automatically for me. Start the auction at 40 cents. Leave it out there for, depending on what volatility is on any given day, you might want to leave the order out there for 2 or 3 seconds, or if it's a quiet day the way today was, you might want to leave it out there for 10 seconds. What's the benefit of leaving it out there for a longer period of time? Well, another limit order might come in. There might be some dark liquidity. The market may move, and a trade would occur that would get you filled. But the walk limit product lets you say, look, let's try to buy these at 40. Let's leave the order out there for 10 seconds. If we can't fill at 40, cancel the order, replace it at 42, leave it out there for 10 seconds. If it doesn't fill, cancel the order, replace it at 44, and it would walk the debit order up or it would walk a credit order down. Two cool features. Number one, it may save you some money. It may give you a fill better than a wide, generous market. And number two, more importantly for many people, I know for me, more importantly, it's a time saver. And what do I mean by the fact that it's a time saver? Well, generally on expiration Fridays, whether they're weekly expirations or the old conventional expiration, it's not uncommon that I'm, working during the day, and now all of a sudden it's 2 o'clock Central, and I've got 3 orders that I've waited too long for. We frequently counsel on this show, get stuff back early, but I'm the shoemaker's son with the hole in my soul. I'm guilty of doing it as well. And now all of a sudden I've got 3 orders working and I'm getting ready for the podcast and I'm busy. The great thing about Walk Limit is it will manage all 3 of the orders. It doesn't cost any more. I get that question a lot. Aren't all those cancel and replaces? Aren't there charges for cancel and replaces? Not here at Options Express. The only thing you pay for is a fill, but come to the site and look at Walk Limit. I can tell you usage of Walk Limit by our customers is growing at a remarkable rate as customers become more aware of it. It's an exclusive here on the OX platform. Obviously, it will eventually be available on the Schwab platform as the OX tools begin porting over there to a larger degree. But come and visit the Walk Limit.
You know what it sounds like, Alex? It sounds like it's kind of having like your own personal broker back in the days when you had the local in the crowd working orders. I'm a quarter bid. Now I'm a 20. Now I'm a 3/8 bid. Now I'm a half bid. Okay, now I'm a 9/16 bid. It sounds like a really nice feature. Of course, I'm dating myself, going back to that's when the brokers used to do. But that's how a broker used to work an order that was standing in a crowd. It was kind of their job to know where things were trading. So
yeah, a good broker, and your characterization is spot on. That's exactly what a quality broker would do, and that's why you paid to have that clever person in the crowd. And when you were in crowds, there were good brokers, and there were yeah. So brokers who were often not as crisp, and they might over disclose what was in the order. And the great thing about Walk Limit is it's done electronically, and it's exactly what the best analogy. It's exactly what a good broker would have done for you. He would have protected his or her client and would have tried to get the best fill they could in the current market environment.
Well, I think that is a great feature, and it seems like it grabs most of the good parts of having a live broker, and you actually get it for the same price as just the normal execution. So, a fine addition, and I know it's been around for a little bit, but again, it's like anything else. You got to educate people on how to use it. So, and I think with that, we will wrap up the Express Block and a birdie very similar to the one Longo listens to. I believe there's a birdie telling me about some sort of strategy, maybe with verticals on the strategy block. And let's see if we can find Mr. Tusaw and have him regale us on the latest strategy on the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
Hello, everybody, and welcome. Put on your, your pipe and your smoking jacket, and kick back and listen to the sweet sounds of Mike Tusaw with the latest episode of the Strategy Block.
And thank you. We are going to be talking today about strategery, strategizing, and timing. Okay, we're just going to talk about timing basically. But what I want to get into today is just to kind of go through these markets as to what we're going through or to kind of go through these markets and discuss a little bit about what I'm looking at in some of my management for clients and what I think might be able to benefit you as well. Let's say that you are a credit spreader. Now, I know option pit people, there is no such thing as a credit spread, but nonetheless, let's say that you like to sell spreads short, vertical spreads, that is. A lot of times when let's say that you're just a dyed-in-the-wool spread seller, a lot of times you want to be in a spread because of the fact that when the market is not moving, it's not going to be helping you in any way, shape, or form. In other words, or when you're not being helped because of the fact that you are not getting to collect that time decay. And when you don't collect the time decay, you're not making any money. And when you're not making any money, nobody's happy, of course. So with that in mind, what can you do to always be trying to make money, be efficient, but yet manage risk in the process? Well, I can tell you from having sold 8,642 credit spreads in my career, okay, probably more than that, I don't know, I just kind of made that up. But my point is that from all the credit spreads with which I have done throughout my career, one thing that I can tell you it truly feels like is when you're not in the market and the market moves against you, it kind of feels like a win. It's kind of nice. So let's say, for example, let's look at our old friend XYZ stock. It's at 55. And normally you would like to sell the 50-45 put spread, let's say. And when the stock gets down to, say, 52, 52.50, something like that, that's your line in the sand to adjust the spread, put on a hedge, close it out, whatever the case may be. But if for some reason you decided not to trade that day because of the fact that you couldn't make it to the screen, you had to do something that day and you didn't have time to watch the market, or you just found there's some announcement coming out and you wanted to avoid it, when the market goes down and XYZ stock's all of a sudden at 51 and you weren't in that put spread, it kind of feels like a win. It's kind of nice. So with that being said, what I'd like to mention today are some times with which I like to actually sell verticals. And let's just start with the put spread. For example, Friday right at the close. Anyone who's listened to this show more than once at least knows how much of a bull that I am on the U.S. stock market. So right at the close on Friday, going into the day, I was actually flat in terms of the credit spread. Now I had some long SPY, I had some long calls, I had some other long instruments, but I had a lot of money on the sidelines for potential put spread sale. And so the markets did go down significantly on Friday, and I sold a put spread pretty close to the close on Friday. Now, what's the benefit of that, and why did that's one of my favorite trades to do, and let me tell you why. First reason is that I'm a bull, and any true bull in the market has never met a dip he didn't like, although there are plenty of them that I haven't liked, but with that, it's a bullish trade. And throughout time, the U.S. stock market does go higher, or it has gone higher, I should say. There's no guarantees of what it'll do tomorrow, but historically speaking, we have had a bull market. However, with that being said, when we have a dip, another benefit happens. The first part of it, you get to be bullish. Second part is that a lot of times implied volatility goes higher. So normally, let's say that you would sell a put spread at, say, the 50-45 level on XYZ stock. Well, if that's the case, then the stock goes down to 51. Now you can sell it at maybe the 46-41 level or the 45-40 level because of the fact that you actually have higher implied volatility, and the premiums with which you desire are going to be there further out of the money. So that's the second benefit as to selling a put spread on a dip, as to why I like it. Now, the third part about it is that I like it when big things have to happen for me to be wrong. On Friday, we had a pretty big down day. And in order for me to have been wrong on what I was selling, to give you an idea of it, I sold this week's 205-202 put spread on SPY. But in order for me to truly be wrong in doing that, markets would have had to have gone down, had another big down day today. Now, that could have easily happened, don't get me wrong. But my opinion is that a lot of times the market overreacts, and there's opportunity when that happens. Now, keep in mind, I could easily be wrong, and I'm prepared to manage risk in case I am, and I've gone through that on the show a lot. But I like to get into a reversal style trade after a large movement, especially when you're doing weeklies or biweekly option spreads. Now, let's say that you are on the opposite side of the trade, meaning that you're a call spread seller, or maybe you're a condor seller, whatever the case may be. Let's say on the call spread side of it, we have a big run up in the marketplace. If that's the case, I typically don't like to sell vertical call spreads. Reason being is that a lot of times when that happens, volatility goes down. And when volatility goes down, you're not going to get quite as much premium as you were if volatility was higher. So after we have a big run up in the marketplace, I prefer to do something along the lines of, and let's say I'm wanting to play a reversal, so to speak, I like to do something along the lines of buying perhaps a put calendar spread. Reason being is that you become bullish on volatility and you're also getting time premium working in your favor. Now, is that the end all be all trade that I'll do every time? Good gosh, no. But similar concept, just the difference is that you're doing something to where you're getting time decay in your favor, only you're in a bullish implied volatility position. So with that being said, I am a long-term bull, but in the near term, when looking for things like that, and you're looking to sell premium in one way, shape, or form, those are some of the things with which I look at, and hopefully they can help you as well. And that is the strategy block for today.
That was a pretty nice strategy block, Mike. I like the timing and the way. I guess could we characterize that strategy, the timing strategy, as one of patience, being patient when the market comes to you, wait for some spots, wait for some opportunities, and just don't go rushing willy-nilly into the first thing you see?
I would say that's it every way. Let me give you a statistic in doing this. For my spread trading for this year, overall, let's see, we have had about 10 weeks of trading so far this year. Does that sound about right?
Yeah.
I have done 6 spreads this year. So, I mean, it's and 6 weekly spreads. And I like to be in something all the time. And I have done 6 spreads so far this year. So I would say probably about more than half the time I have not been in it, because some of them have just gotten, by doing this, I've been in and out in a day or two, and then others I've been in and out in maybe a couple of weeks. But in terms of saying patience, it's okay to go to cash from every now and then.
I think I think those are great words to live by the way. And you could use the OX walk limit and be patient on entering. Look at all
could life possibly get any better?
I don't know. All I can say, there's a whole lot of good coming out of the the option block today. And with that, we are going to segue out of the strategy block, put away the smoking jacket and pipe, and cruise into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right, everybody, and now we are rolling into, close to the final segment, but second to last here. We're going to roll into the mail block. This is the part where you, the viewers, give us your insight, your questions, your feedback, and we try to read it here on the show. Keep the cards and letters coming. I guess that's kind of the old-fashioned. How about just keep the emails coming to the Options Insider Radio Network? We have a couple of questions here. The first one here, and I think it's a follow-up to the strategy block in some ways, but we're going to make IJay happy. So here is for Mr. or Mrs. IJay. Are a lot of people trading weekly options? If so, what are they using them for? I don't know, Mike. Do you know anything about using those weekly options?
Oh, way too much. I know that if you want to damage your kidneys and sit in front of the computer all day, they're a great thing to trade. I can attest to that firsthand. I like the weeklies, and I stayed away from them for many years. I remember they first came out, and I believe it was 2005, 2006, something like that. It's been a while. I don't know the exact date, but they came out a while ago, And the way with which they originally came out, you could do a 1-week option, but then it would jump to a monthly option. So you could either do a 7-day option or a 28-day option. And very seldom, and they would just renew every week. I think it was like every Thursday you'd get more options. And if you want, what you can do, IJay, you can go on to the Options Insider Radio Network app and download some of our shows between 1 and 100, and you will hear me ranting. And this is back in the old days, but you'll hear me ranting about how we needed to have 1-week, 2-week, 3-week, and 4-week options to go along with the 1-week weeklies with which we had. I typically like to do 2-week options whenever I'm trying to hedge something or whenever I'm trying to sell premium. I'm not a huge fan of the 1 weeks. Not to say that I never do them, but most of the time I find myself in a 2-week option just because I feel that the extra time with which I have to hold on to it is worth it because of the extra cushion I'll get between a short option strike or the extra time decay that happens. It just, the way with which it works, it usually comes out better from my experience when I'm selling options to do a 2-week option. Now, the way with which I select a time frame for an option is there's a process to it, but to oversimplify it, I shop around and try and get the best bang for my buck. So let's say that XYZ stock, let's just say I want to sell a put. XYZ stock's at 50 and I want to sell something to where I can get 50 cents for the XYZ stock put. I'll look at maybe, let's say, and it depends on how volatile the stock is and it depends upon a lot of things, but let's say that I can sell the 47 put for 50 cents front week. Okay. But if I go 2 weeks out, I can sell the 47 put for 98 cents. Well, typically I would take the bet of the 98 cents. Now, yes, I know what you're thinking. You're probably thinking, well, wait a second, 50 plus 50 equals $1. Why would you want to take 2 cents less on doing a 2-week option as opposed to a 1-week option? And I'll tell you why. For 2 cents, it's not worth taking on the risk of not making my next week's premium. So in other words, let's say that as soon as I get into XYZ stock, XYZ stock goes from 50 to 80. Well, both of those options, both the 1 week and the 2 week, are going to be trading at maybe 0 cents by a nickel or something like that. And I will have been better off to have been in the 2 week option because I got more guaranteed premium. Now, let's say for some reason, and a lot of times that's kind of the analogy that I could give of what I see. Now, a lot of times I'm looking at spreads and I'm looking at different things, so it doesn't come out exactly the way with which I described. But once again, I'm trying to oversimplify this. Now, let's say for some reason that we looked at the same stock, same premiums, and the front week option was trading at 70 cents, and the 2 week option is trading at maybe $1.05. There's always going to be some point with which I can't resist taking the front week option because the premium is more. However, if you do see something like that, which I do from time to time, there's this one stock I trade. I forget the name of it. Apple. Sometimes I'll see things like that. And if you'll see things like that in Apple, then a lot of times there's a very good reason as to why I'll see something like that, because of the fact that maybe that there's an announcement about maybe iWatches or something like that. Now, I didn't do any weeklies going into this announcement today, but a lot of times that's the case as to why you have that type of option skew. So then if we have that, I know that right there at that point in time that I'm better off from just a monetary standpoint taking the front week option. However, from a risk standpoint, I might be worse off because of the fact that there might be more event risk factored into the front week option. So at that stage, what I'll do is I'll determine, okay, what's the event? Why do we have so much more premium in the front week instead of the second week? Time decay, relatively speaking, per day, of course. And if that reason, to me, if I'll say, okay, well, I think that event's going to be, as Mark Longo would put it, a resounding meh, well, I'm going to sell the front week. But if I think, yeah, that's true, maybe we could get a little bit more dicey this week because of that event, then I might go with the following week, or maybe do something along the lines of being a little bit more cautious of selling like a 46 or a 45 put. So in terms of what are you using them for, I like to use them for time decay and trying to harvest premium. I don't like using them as a hedge before an earnings announcement. I don't like buying front week and 2 week options. I just don't think it's a very efficient way of using your money. And I also am really not a fan of doing overnight options. So a lot of times you'll see online, people say, you know what, I can make a 3% rate of return by selling this covered call, and I just have to hold on to it for 1 day. I'm against that on so many levels. Well, actually, I'm for it, because when people do that, eventually they blow out and they come to become a client of mine. No, just kidding. So that I'm not a fan of, but you do see a lot of that with some online newsletter services. So I'd be wary of that, and that's how I use the weeklies.
That was altogether excellent. Now, would it be fair to sum up for IJay here that your judicious use of the weeklies, you're trying to be, just in case you're short-term wrong, you still want to have a chance to be long-term right. So you have maybe you're trying to build yourself a little sweet spot, just in case things short-term kind of go against you. Having that extra week gives you a little time for the market to sort of, let's just say, gather itself and be able to really look ahead and give your short juice a chance to just go where it's supposed to go, which is right to zero.
I would agree on that, yes.
Well, I think that answer was so fantastic. I think we're just going to wrap up the mail block right there. And we are going to move into what's going on here and what you guys are watching here at the end of the week. We're going to go right to Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, and welcome back to Around the Block. Here is the portion of the show where we will see what Mike and Alex and Andrew are looking at. Where are they focusing their laser vision here with 4 days to go, and we're kind of moving right through March into starting to look at spring. But what are you guys looking at here, just moving forward here over the next week? Let's go, Mike.
Okay. Besides all the offseason moves the Buffalo Bills are doing, which I think they're going to be phenomenal this fall, I am looking, and the Chicago Bears trading Brandon Marshall. I am actually even more laser focused than usual on Apple. I think with what they announced today, I think that we could have some pretty decent movement on it. Sometimes after Apple has an announcement, it kind of doesn't seem to move too much that day, but then the following days is when the market seems to kind of digest it. So I am staring at Apple with even more bated breath than usual.
Wow. And that is so surprising to me. Yeah, I just saw the volatility just fall apart in there. It'd be interesting to see if we get a little move out of Apple, but I will keep an eye on that as well. Mr. Jacobson, what are you watching here? Just moving on into this kind of, so far the week is starting off a little sideways. So what are you looking at here?
Watching the price of oil, watching the core indexes, the S&P and the NASDAQ composite, to see if we can get back above the highs we set last week before we broke down out of there. I'm watching rates, U.S. 10-year back up by 220, and as I mentioned, the German 10-year looks like it's going to zero. I think it's going to be real telling about the economy, but other than that, price of oil, the VIX, not trading below 15 today, but then ending up just a hair above it. I'm still bullish. I think we're going to move higher. I think the world is waiting to see what the European Central Bank continues to do, and that's what's lit up on my screen.
Yeah, I think the only thing is maybe I'm even just looking to next week. I think this week's going to be relatively flat overall. We might see the low 14s for VIX, but I think volatility will keep a slight bid, because all of a sudden next week's minute release might have a little more oomph to it as far as if the Fed changes some language. So, not much has happened in this week, but maybe something's happening next week. And I think that's kind of the way It feels like it's going to play out anyway. So we will see how right that is. And I guess last but not least, what do you guys got going on here? What events, what things, what happenings and do's do you have going on here for coming in the near future?
Wednesday night, RCM Minneapolis, rcmfutures.com. We have a futures alternatives event. So if you are a futures trader, an option trader, if you even know how to spell the word derivative, come on by. We'd love to have you.
Wow, that actually might take out about half the populace right there. Once you said
okay, even if you're close to spelling the word derivative, then you can come by.
Call or put or future. And Alex, how about you?
Put.
Alex, what do you have? What's going on at Options Express by Charles Schwab? What are they got going on?
Yeah, well, there's tons of stuff going on, but I'll just focus on a couple of days. Wednesday, March 11th, Mike Zaremski's doing a new customer onboarding for futures customers, and then Nina's doing a couple of webinars. Nina's doing, again, on Wednesday the 11th, she's going to do order entry, advanced order features, and the walk limits. So if I pique your interest in the Xpress Block, come listen to Nina expand upon the walk limit. After that, she's going to do covered calls in IRAs, and the last event I'll showcase, a second live event in the month of March. Jimmy Ruzan and the crew will be in Phoenix, Arizona this Saturday. Live event. He discusses the site, the tools. Jimmy and his crew does a great job. Generally, the live events are done in conjunction with some of the local Schwab folks, so it's kind of a cross-pollination event. All the events are free. You can register or come to an event pre-login. Just come to optionsexpress.com and click on the free education tab.
All righty. Well, with all that stuff going on, what do we have at Option Pit? We have, if you go to www.optionpit.com/income, you could pick up the last Saturday webinar that Mark and I did. Also, we'll be having another Saturday webinar, which we are announcing soon. And other than that, just stop on by, check out our chat, all the goodies we have, educational stuff at optionpit.com. And with that, I think that'll do it for us, for Alex, for Mike, and myself, Andrew Giovinazzi. That will do it for this episode of The Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.